Hey guys, and welcome back to another video. It's me, Adam, and you are watching Unlimited Options Investing. We have tons to talk about today. It looked like a pretty green market out there, as well as the big news of the yield curve inverting, the 2-year and the 10-year yields inverting for the first time since 2019. And why is this a big deal? Because ever since we've been tracking the yield curves inverting, every time afterward, a recession has followed not too far into the future, maybe within a year or within 2 years. So don't go anywhere. It's going to be a good episode. Before we start, if you haven't already, smash that like button, subscribe to the YouTube channel, and check below in my description my Twitter, my Instagram, and my TikTok. Check it out. Alright, so the heat map for March 29th, 2022, and we have a little bit of green all over. Technology first, we have Apple, Microsoft, Nvidia, Adobe having a good day, software pretty green, Google up about 1%, Facebook, Meta Platforms up 3%, Amazon pretty much sideways on the day, and Tesla marginally up by 0.71%. Looking around the rest of the map, Disney and Netflix under entertainment pretty green, financial credit services, Visa and MasterCard, whereas the banks were pretty much sideways, JPM, Bank of America, Wells Fargo, Citigroup up about 1%, Berkshire down 1.24%, healthcare pretty sideways, and seeing a lot of green around defensives, which we haven't seen very much of over the last couple of weeks. Restaurants, real estate, consumer defensives. Industrials also having a pretty green day with energy not nearly performing as well. Crypto also looking pretty sideways for the last 24 hours. Bitcoin down 0.34%, Ethereum up 0.5%, XRP down 3.49%, Cardano down 1%, Solana up 2%. But of course, over the past week, up 12% for Bitcoin, Ethereum 14%, XRP up 3%, Cardano 24%, and Solana almost 25%. But again, the big news on the day, the yield curve briefly inverting for the first time since 2019. The market's most closely watched part of the yield curve inverted very briefly today on Tuesday. At 1:33 p.m. on Tuesday afternoon, Bloomberg data showed the yield on the 10-year U.S. Treasury note briefly dipping below the yield on the 2-year U.S. Treasury. The inversion lasted only a few seconds, and by 3 p.m. Eastern, which is the settlement time for the U.S. government bond futures, the curve remained uninverted with about 0.05 separating the two securities yields, so about 5 basis points. Over the last half century, the yield curve inversion has been a recession indicator, but others say the Federal Reserve's unprecedented firefight with high inflation would make the yield curve inversion different from those of past decades. This phenomenon has a strong track record of predicting a recession. Each of the last 8 recessions, dating back to 1969, were preceded by the yield on the 10-year falling below the 2-year. The yield curve maps out the U.S. Treasuries of various durations and usually shows longer dated Treasury, like those with 10-year or 30-year maturities having higher yields than shorter dated Treasuries, i.e. 3 months or 2-year maturities. So the curve inverts when yields on shorter dated Treasuries rise above those of longer dated ones. Because you do expect a higher rate of interest or higher rate of return the longer you lend out your money. So points of the curve have already inverted in recent weeks, the 3-year and the 5-year on March 18th, and the 5-year and the 30-year on March 28th. But the 2-year and the 10-year points are often looked to because they are among the most commonly traded durations, and inversion in these particular points has correctly predicted a recession with a lead time of between 8 months and 2 years in each of the last 8 recessions. So every time we hit this x-axis, that means an inversion of the yield. The last time we saw this was in 2019, and of course we got the recession from the pandemic not too far after that. I believe the inversion was in August of 2019, and the market crashing and the recession starting in the first quarter of 2020. Of course, the great financial crisis, the tech bubble in early 2000, again inversion, recession, inversion, inversion, inversion. So to which we have to ask, is there an incoming recession? There is nothing about bond pricing that directly triggers a recession. For example, when the yields inverted in 2019, there's no way financial markets could have known a global pandemic would have been the reason for that recession. Some strategists have warned that more context is needed when looking at this year's inversion among the 2-year and the 10-year yields. In the face of rapid inflation, the Federal Reserve is in the process of hiking interest rates at its fastest pace since 1994. Bond markets have had to quickly reprice through the policy pivot, meaning that inversions could be a temporary side effect of the Fed's action, instead of a more fundamental market worry about duration risk. There are some real distortions in the yield curve right now. JP Morgan Asset Management's Mira Pandit told Yahoo Finance on March 21st. She added that there are also two other narratives that are keeping longer end yields down: foreign interest in U.S. Treasuries and the Fed's direct ownership of trillions of U.S. Treasuries. Bank of America's Global Research wrote March 25th that a yield curve inversion would be a distraction given a U.S. economy that has had its fastest labor market recovery, now at a near historic low unemployment rate of 3.8% and GDP growth back to pre-pandemic levels. Now everyone's going to have an opinion, even Elon Musk. If history is any guide, not many will make it past the next recession. And he's correct in saying that predicting macroeconomics is challenging, but the world's most influential businessman and richest man, his gut feeling is maybe around spring or summer 2022, but not later than 2023. Whereas we have Fed Chairman Jerome Powell speaking more like Bank of America's Global Research, reiterating the labor market and GDP growth. And looking at the 10-year yield on the chart, this one has had a very strong 2022, but nothing like the 2-year yield going straight up ever since the end of September last year. Now, will these continue inverting? What does it mean? It's anyone's guess. Let me know in the comments below. What are your thoughts? Are we going to continue seeing higher yields in the 2-year than the 10-year? Or is this something just short-lived? Are we going to see a recession in the next 12 to 18 months? Let me know in the comments below as always. Subscribe, like, and check out the description for my Twitter, Instagram, and TikTok. See you in the next video.